All right, today we're going to break down one of the most talked about topics in finance, stock ownership. We're going to skip all the confusing jargon and get right to what it actually means to own a piece of a company. So, let's just dive right in.
Let's start with a really simple idea. Think about a company you absolutely love. Maybe it's the phone you're holding or the coffee you drink every morning. What if you could be more than just a customer? What if you could actually own a tiny piece of its future? Well, that's the whole idea behind owning stocks.
So the way you own that piece is by buying something called a stock. But what on earth does that term even mean? Let's get right into it.
At its very heart, a stock is basically just a certificate of ownership. When you buy a share of stock, you're literally buying a tiny, tiny fraction of that company. You actually become a part owner.
Here's a great way to think about it. If a giant company is like a whole pizza, you don't own the entire thing, but you own a slice. If it's a skyscraper, you don't own the building, but you own one of the bricks. Each share you buy is your small but very real piece of the pie.
And owning that share, that slice of the pizza, gives you a new title. You're now what's called a shareholder. It means you have a real stake in what happens to that company, for better or for worse.
But why? Why do companies even do this? Why would they sell off little pieces of themselves to the public? Well, it all comes down to a really big idea they have.
The number one reason is to raise money. You'll hear the fancy term capital, but it's really just cash. And we're not talking about pocket change. This is the kind of money that fuels massive growth, funds brand new inventions, or helps a company expand all over the world. So you can see it's kind of like a two-way street here. The company gets the cash it needs to go out and do big things, and in exchange, you, the investor, get to own a piece of that company's potential future success. It's really a win-win relationship.
Okay, so let's get to the question everyone wants to know. You're a shareholder, you've put your money in, so how does that turn into more money for you? Well, there are a couple of key ways. It really boils down to two main ways your investment can pay you back. The first is if the stock's price goes up, and the second is when the company decides to share its profits with you directly.
Okay, so price appreciation is the one you hear about most often. Let's say you buy one share for $10. If the company does really well, other investors will want in, and all that demand could push the price up to, say, $15. If you sell it then, you've made a $5 profit. Simple as that. And the other way is through dividends. You can think of this like a thank you bonus. If a company has a really profitable year, its leaders might decide to share some of that profit directly with its owners, and that's you, the shareholders. It's a straight-up cash payment, a reward for your ownership.
Now, it's super important to know that not all stocks are created equal. The two main types you're going to hear about are common and preferred stocks, and believe me, they come with some very different perks. It really just comes down to a trade-off. With common stock, you usually get voting rights. That means you get to have a say in big company decisions, like who sits on the board of directors. But with preferred stock, you typically give up that vote. So why would you do that? Well, in return, your dividends get prioritized. You get paid first, and the payment is often a fixed amount. So we've talked about stock prices going up, but of course they also go down. And that brings us to the famous, or maybe infamous, volatility of the stock market. It can feel like a real roller coaster.
This is the million-dollar question, isn't it? Why is the market up one day and down the next? It might seem random, but it's actually driven by some pretty powerful forces.
First off, it's just basic supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people are selling, it goes down. But what drives that demand? Well, a lot of it is based on the company's own performance, like a fantastic earnings report. But it's also influenced by bigger things, like the overall health of the economy.
In this quote right here, it just perfectly captures the investor mindset. The market is going to have its ups and downs. That's a guarantee. The whole game is about being willing to accept that short-term turbulence for the chance to build real wealth over the long haul.
So, with all of this information, we get to the most important question of all. Is investing in stocks the right move for you?
You know, because of that roller coaster we just talked about, stocks are generally best for people who have a long-term mindset. We're talking years, not days or months.
This right here is the fundamental exchange of stock market investing. You agree to ride out the market's temporary storms. In return, you're positioned to capture potential growth over many, many years. That's the core bargain you make as an investor. So we've covered the what, the why, and the how of stocks. You now have the essential framework. So the only question left is, Now that you're armed with this understanding, what kind of future do you want to be a part of?